Let's talk a little bit about the tick size proposal. We've advocated for tick size changes in the past. Maybe start with you, Stephen. What's our take on this idea?
There is a universe of stocks for which reducing the tick size from a penny to a half a penny makes good sense. We've been recommending that dating back to at least 2014. So we're certainly heartened to see that the SEC is looking at reducing tick sizes, but I think they've unfortunately gone way too far. And they're proposing slashing tick sizes not just from a penny to a half a penny, but all the way down to a tenth of a penny for thousands of symbols, as opposed to those that are actually tick constrained and sufficiently liquid to support a narrower tick size. The feedback we've seen from investors across the board is that the SEC is embarking upon an experiment that doesn't have much empirical or data to back it up.
As Stephen said, whenever you're making changes to something that's very fundamental to the market mechanics, you need to start with data and you need to start with identified problems and you need to show how whatever you're changing is going to improve that. And in addition to the quoting increment component going too far and beyond supported data, there's other changes embedded in this proposal, like the increments that stocks trade in and the amount of fees that can be charged. And these things sound simple, but they're highly complex and they're very, very difficult to predict in practice how they're going to change a lot of the market dynamics. And a lot of these things are what ultimately have led to free commission trading for retail investors. And one of the concerns that has been raised is as you tinker with a lot of these market mechanics and as you change with some of the things that have generated the ability for retail orders to trade for free, is making sure we don't unintentionally move the economics in a direction where retail has to reinstate commissions and free trading is a thing of the past. That would certainly not be something that I think most people would view as progressive for the markets.
Joe, you mentioned free trading, and obviously none of us want to see commissions come back, but there is a criticism out there, right, that there is no such thing as a free lunch, or if something's free, then maybe you're the product. How would you respond to that criticism?
It's important to understand why retail orders are attractive to market makers. And the reason is because there isn't larger order sizes behind the orders that you're interacting with like there are with institutions. And so that enables market makers like us to give a better experience through better prices and more liquidity to retail orders. If we move to a world where we're not able to directly interact with retail orders, then that benefit that retail currently gets is going to get transferred to the broader market. And that is certainly a world where it's not better for the retail investors versus what they get today.
What are you hearing from the buy side in particular on this one?
The buy side has expressed a great deal of concern with respect to going all the way down to a tenth of a penny, given that the experience where that's occurred elsewhere has led to much less displayed liquidity available at the best bid or offer in a market. So we took a close look at what happened in Japan after tick sizes were narrowed there a few years ago, and we've included this analysis in our comment letter. And again, you saw the amount of displayed liquidity available at the best prices in the market go down dramatically. And that worsens the outcome for mutual funds who are trying to and rely on the ability to access that displayed liquidity in the market. And I think it's important not to forget the fact that these mutual funds are investing on behalf of tens of millions of households across the country. So that is the interest of household investors, and the concern that those funds have expressed is their execution quality is going to diminish if we take these radical approaches to tick size reform.
Right. And that obviously harms 401ks, mutual funds, and as you said, everyday Americans.
Exactly.
I think from a retail investor experience in particular, you don't want our equity markets to look like gasoline prices, where you're quoting in increments that look like what you see on the top of the gas pump. And I think that's generating a lot of that view of, if we're going to take the step of going below a penny, do it in a very measured way, start with a half penny, see what that looks like. But going to gasoline prices as a first step just seems irresponsible.
Stephen, this isn't the first time the SEC has thought about or tried to change tick sizes. What happened the last go around?
I think it's quite notable that the last time we experimented with tick size changes, it was a widening of tick sizes from a penny to 5 pennies or 10 pennies. Many predicted that would not go well. It didn't go well. It cost hundreds of millions of dollars, and the SEC ended that pilot. But at least it was done through a pilot program that could be unwound and ended. Across the board, from exchanges, from institutional investors, from the broker-dealer community, from academia, I think you've seen almost universal concern that going to a tenth of a penny and subjecting too many stocks to significant reductions in their tick sizes is going to have material adverse consequences on the market.